Hello, my name is Martin, this is Millionaire Autobahn. So today we're again talking about the Back to School series, Start Trading in Your 50s, and we're talking about support and resistance and trading patterns and volume, these type of things. For new traders, this is all kind of like, hard at first to understand. Once you get into it, it's actually not that bad. So just to let you know, this is no financial advice. This is my personal journey on day trading. And these videos are for entertainment purposes only. If you like the videos, please like and subscribe. It would help tremendously. So, getting into it. A lot of people or let's say a lot of people are overwhelmed by all the indicators that you actually can see on a trading chart, right? There's so many different ones. I would say it's easily in the hundreds. Everybody has their own personal view on what indicators they actually want to look at. Some only want to look at, let's say a moving average, or at the volume, or at support and resistance. And others, they want to see like 5, 6, 7, 10 different indicators on one chart. So you don't actually see the trades anymore. You just see a lot of lines going, everywhere. But that's fine. Whatever everybody wants, that's their personal choice, right? But you gotta understand that all these indicators are doing is just to give you a guidance. They're not to tell you exactly now you have to buy, now you have to sell. Even though there's many indicators out there, and I did some myself, that actually kind of show it now is a good time to buy, now is a good time to sell. But in general, it's always down to you what you think makes sense or doesn't make sense. That's very, very important to keep in mind. Because in general, overall, it's just you versus the market, right? And any indicator or any pattern you see could just be a fluke. It just happened to be like that for this moment, but it could be, a second later, it could be totally different. So keep all that in mind, please, when we go into these. So I have my monitor running here, my computer running, so let's just hop into it so I can give you a little bit more information about different types of indicators and patterns. So to me, I think some of the most important indicators, and as said, that's my personal view, is support and resistance, the volume, and the 9-minute moving average. There are, of course, as said, many more. You can have like a day moving average, a 10-day, a 20-day moving average, and so on. I'll go into that a little bit, what these are, what that means. Okay, so here on the screen I have the Ether ETF. That's an ETF that's actually leveraged twice or 2 times, however you want to say. What that means is if Ether goes up, let's say 1%, this would go up in general 2%. So what do we see on this screen? So we see here is actually a line. So let's get a line up here. We have a line that is what I call the resistance, okay? And then we do another line on top here. That is what I call support. So what does that actually mean? Why do we have, and every stock does have that. That doesn't matter if it's like an ETF or if it's Apple or Tesla, whatever it might be. That's important to understand what does that mean. And not just say, yeah, here's support and here's resistance, but what does that actually mean? So you see that in this case, the stock doesn't go higher than a specific point most of the time, and it doesn't go lower than a specific point most of the time. So what happens is there's institutional investors, let's say like BlackRock You know, they have like billions of dollars, and they actually say, okay, we want to buy this particular stock at a certain price. So let's say in this case, they want to buy at around $147. So what that means, if the stock goes down and touches the $147 mark, and they have a buy order in there to buy, let's say, 1 million shares, obviously, they're not getting 1 million shares right at that moment because there's not 1 million shares for sale at that time. So they might get 10,000, 20,000, 30,000 shares at that particular time. And what that does is, because of that, the stock moves up again because they are buying, and then other bigger investors or institutions are buying at the same time. So you will see that then the stock trends up again. Okay, and then you see that it bounces back on this next line here. So this is the resistance. So the stock doesn't go higher than this particular line. What does that mean? So that means that around $151 in this case, there is a selling pressure. Meaning, again, an institutional investor, might be the same one or another one, has, let's say, 1 million shares of this particular stock and wants to sell at $151 or around that area, right? And that's all automatic. There's not somebody sitting there and said, oh, now I'm selling. That's all automatic. That's in the system more or less, right? So what happens is there's all these buyers and they come up to that particular line of $151. And then there's a huge sell-off. Meaning all of a sudden there are more shares to sell than there are to buy. And that triggers again that the stock will go down. Because then all of a sudden a lot of other people say, oh, I got to sell because now this big institutional investor is selling. But it still goes back up, you know, a couple of times to that particular line again, because at the first time they didn't sell all, let's say, 1 million shares. So they only sold, let's say, 200,000. So when it comes back to that $151 mark again, they might sell another 200,000. So this is as many times as it actually comes to that resistance line. Once they have sold all the shares, that resistance line is gone and the stock is actually able to move higher. Let's just see, and we can see actually right here, that then the stock moves higher after that. And as I said, the same is true for when the stock goes down, when there is a buying demand at the $147 mark. So when there's a huge buying demand, it bumps off that line and then jumps up again. And then we see in this case, all of a sudden, so this seller here has sold all the shares. That's why the stock is able to get higher if there are still a lot of buyers in the market. So this is, to me, one of the most important information that a stock can give you. When you see this goes up and then, you know, it doesn't get higher than that and it doesn't get lower than that, you know that's where a support and a resistance line is. This is when a big institutional investor is either buying or selling a huge amount of shares. And only when that is depleted, when they sold or bought everything, then it will go through that line. So that's important to understand. And obviously you don't know how many they want to sell or buy. You can just, you know, see what's happening. But that gives you always kind of a little bit of actually pretty good advice to say, okay, it bumps on that line and it goes in the opposite direction. You then can actually go in for long or short if it is on a resistance. That should help you actually go in the direction that you want to go. So the next thing that to me I think is very important, and we see that on the bottom here, that's the volume. That's the volume of how many shares are actually traded. So the higher the volume, the more the stock is moving. And as we can see, like here's a huge red candle right there. No, the red candle is here, sort of that. So there's a huge volume in red, meaning, okay, there's a lot of sellers in there. That's why the stock goes down. So, and that's the case always. And then when you have a lot of buyers, you have high volume of buyers, then the stock goes up. So it's actually pretty simple when you think of it. It's just the amount of buyers and sellers out there. That's what moves the stock really. Nothing else. That could be good news. If nobody is buying or selling, the stock would just, do nothing. Only if the buyers and sellers go in, the stock is actually moving. So that's important to actually, understand. So, yeah. But yes, so this is another important indicator when you see, there's a lot of sellers. So in this case, there are more sellers than buyers. That's why the stock goes down. And we can see again here, if we extend this line a bit, we can see that it's again kind of, bumping up on the $147 mark here. So it looks like there is a huge institutional investor in here that buys around that dollar amount. That's why the stock went up again on that time, right? So those two are actually very important. So the next one you see is this orange line here. This orange line is the 9-minute moving average. And as I said before, you can have like a day moving average, a 20-day moving average. So what that does is it gives you a little bit of guidance on how the stock is trending in general. So if it's always above this line, the stock usually then goes up. So like when you see it comes down here and then the green is above, that's usually a good time to say you want to buy. The chances are quite good that the stock will go up further, staying above this moving average line, right? So if you do like a 10-day or a 20-day, this line might look totally different, but it has the same purpose. You just want to be above the line if you want to go long, or below the line if you want to go short. That's the main takeaway out of this, right? So you see here it goes below the line, so there's a good time to go short till it goes down, bumps up on that particular resistance there when it goes up again. So you kind of get a little bit of a guidance on actually what to do, right? And I like the 9-minute one because it's more kind of, let's say, up to date. Whereas if you take a days, 10 days or 20 days, what that actually means is the particular trade or the particular time frame that you're looking at right now over or under a time frame of 10 days or 20 days. And that, I think for day trading, that might be actually too big of a time stretch. But as I said before, that's really up to you, what you like. Do you like it, a bigger time frame or a smaller time frame for these things, right? And also to note, so I usually look mostly on the 5-minute chart. I think that's kind of the most used, I would guess. But yeah, this kind of helps me to see what is happening. So if you're in trading view, on the top here, you can change that to whatever you want. You type in 30, then you have a 30-minute chart. So let me just reset that real quick. So then you have a 30-minute chart. If you want to have like a day, you want to see a little bit further out, 1D gives you the day. So you can see what happened over a longer period of time. So this is then like 1, 2, 3, 4, 5, 6, that's like 8 months that you see on the screen right there. So sometimes you want to actually see that to see, okay, what did this particular stock do in the past, to actually find those support and resistance lines, to see if there always has been support and resistance at those particular price points. So that's kind of important. But for day trading, this is only for looking before you actually start trading the stock. You want to see a larger time frame to see what's going on, what has happened in the past. But for actually doing the trading right then and there, I would say the 5-minute chart is what you're looking for. So let's just go back to the 5 minutes here. And so we're back to where we were before. So now there's also the patterns, you know, it's called like a double top, a double bottom, you know, the Wyckoff method and so on. There's all sorts of different patterns out there. I personally am not really that big of a fan, because I think it's just like a 50-50% chance that that pattern actually works out as you would think. But that's my personal view. Again, you know, you might say, oh, this is like the best pattern ever, and you like it, and it goes that way. But you gotta think one thing. So if we go, let's say, to a 1 minute chart here. Okay, so here we see something like, this could be maybe a little bit like a double bottom, you know, when it goes down twice, and usually then what is said goes up at the end again. But then if you do the same thing in a 5 minute chart, this particular curve you see here would actually not be visible. So if we do the 5 minute chart, then it pretty much doesn't exist. So it depends actually what time frame you're looking at to see if these particular patterns, if they actually make sense, if they work for you or not. But as said, in general, I actually think what I just showed you with the support and resistance and why it's happening, the volume, the moving averages. And then there's one other thing I want to actually show you real quick. So the VWAP is the volume weighted average price. So what that actually means is that usually you have like this top line here, you have a bottom line, and you have like the line in the middle. That's kind of the medium of this whole thing. So that gives you kind of an indication. Once it goes below this green line, it's a pretty good chance that it will go up again, because depending on the volume of trades, it has not gone below this line for a long time. And the same is true for uptrend. So if it goes up, you see here, it's always kind of in between the lines, and then it kind of breaks out. As soon as it goes above this green line, it is a strong buyer's market. So it suggests that the price will go higher and higher, but usually it will come back again into this particular frame, let's say, right? That's where the stock usually resides in. So you know, when it touches on this line, that's when you say, oh, okay, now it looks like it might go down again. And the same is true when it touches on the bottom. That's when it might go up again. It's not a given, but it's some sort of a good indicator, I would say, right? Yeah, so those are the ones that I think are the most important for day trading. And I advise, or my personal view, as said, I'm not advising anything. My personal view is to just use these and nothing else really. Yes, of course, there's often like things when you say, oh, you have like this a little candle. What's happening after a little candle? Why are there actually those little candles here, you know, that have like a small body but big wicks? Just so you know, that usually means there's the buyers and sellers are kind of competing. So it goes up and then it goes down again. But at the end, it kind of stays at the same price or similar price that when the candle started. So that's what these actually mean. But it doesn't really give you an indication where it will go next. You could argue, like in this case here, it's a selling point. Then you have this small candle that actually went up quite a bit, went down again. That something like this would suggest that at the end, the next candle would go green in this case. But as said, I wouldn't really go for that, to be honest. It also depends on what time frame you're looking at. But that's, as said, only my personal view. You can do whatever you want, however you like it, right? So yeah, so those are the things that are important to know about day trading when it comes to indicators and when it comes to patterns. As said, indicators I think are important. You need to know about those, how they work, why they're there. But the patterns, in my personal view, are nice to have. They might work, but they're not a given that they work. I actually, in my short journey so far on day trading, I looked at a couple of patterns and I had them always on the side to look at to see, oh, this is this pattern, this is that pattern. And to be honest, most of the time the patterns were just patterns. They didn't do nothing for me. I would not go the route of looking at all the different patterns. It might work, it might not. I think it's a 50-50 chance that they work. So it's like you're not looking at them at all anyways. So that's my personal view about this, right? Important is support and resistance, the moving average, the volume, and the VWAP. Those four, I think, are the most important to understand, to know why they're there, what they're doing. So you actually can have a bit more informed decision on, do you want to buy or do you want to sell a particular stock, right? So yeah, that's it for today. The next video that comes out in the Back to School series is about what to do when you actually make something wrong. So if you go into a trade and it goes south, what actually happens? So that will be the next video. I think it's an important one, and I will see you next time. All right, thank you so much. Bye.